Welcome back to the deep dive. Today, we're strapping in for a focused analysis. We're looking at the fiscal Q4 and full year 2025 earnings for a leading sorbent minerals company. So if you're prepping for a meeting or, just want the quickest way to understand this pretty critical financial print, well, you're definitely in the right place. We've got results that, frankly, scream success. A record year, 17 straight quarters of year-over-year sales growth, impressive stuff. But the core question, it's always the same for investors, isn't it? Are these results sustainable? And maybe more importantly, did the market actually buy the story behind the numbers?
Well, the answer seems to be a pretty unequivocal yes. The financial print itself was exceptionally strong. And that led to a notably positive market reaction. I mean, we saw the stock jump over 8% on heavy volume the day the call actually happened. This wasn't just like another record year. It felt like the clearest evidence yet that their whole multi-year strategic pivot is actually working.
Okay, let's unpack this then. On the surface, yeah, the numbers look phenomenal. Fiscal year 2025, a record year. Plain and simple. And looking just at that Q4 snapshot, revenue hit $125.2 million. That's a solid 10% increase year over year.
Right. And the bottom line, that's where you saw the real shockwave, I guess. GAAP diluted earnings per share came in at $0.89. That's just a massive 51% surge compared to the prior year. 51%.
Wow. Okay. That kind of leverage, it suggests something fundamental has really shifted in the business model itself, right? Not just, selling more volume.
Precisely. Exactly. If we dig into let's say, the quality of those earnings, net income was up 53% year over year to $13.1 million. And EBITDA climbed 17% to $21.4 million. Now, what's fascinating here really is that the growth wasn't like evenly spread around. The business to business segment, the B2B side, that acted as the engine for this entire performance. It drove this profitable product mix. And that was strong enough to completely overshadow some minor margin compression elsewhere.
Yeah, that B2B momentum is clearly the main story. I definitely noted that huge disparity in the segment growth rates. The B2B side, where the high-value industrial materials live, for purification, agriculture that grew, 24% year over year, hit $48.1 million. Just huge.
Correct. Meanwhile, the retail and wholesale segment, R&W, which is, let's face it, mostly the cat litter business, that grew pretty modestly. Only 3%, up to $77.1 million. So this favorable mix shift moving towards those higher priced, higher margin B2B products, that was absolutely mission critical.
So, okay, we see this impressive bottom line growth, but you mentioned margin pressure. There was a bit of a pullback in gross margin, wasn't there?
There was, yeah. And it actually speaks to their strategic focus, interestingly. Gross margin did pull back 120 basis points, so 1.2 percentage points down to 27.8%. Now, this was mainly due to higher material costs and also that internal mix shift needed to support the accelerating B2B growth. But, and this is the key part, because those B2B products carry such high value, that product mix acted as this powerful tailwind. It ensured the overall profitability still climbed dramatically.
That focus on, let's call it profitable growth, it clearly shows up when you look at cash flow and the balance sheet. Operating cash flow increased, 33% year over year to $80 million. That's impressive. And the company ended the year sitting on $50.5 million in cash and equivalents. That cash position, it speaks volumes about their financial discipline.
It really does. And management introduced this pretty intriguing concept they called Moneyball.
Ah, yes, the mining version of Moneyball. Right. But for listeners who maybe aren't familiar with that analogy in this context, what exactly does Moneyball mean here? Is it just like a cute term for being careful with money?
Well, it's a bit more strategic than just being prudent, I'd say. Moneyball is their term for essentially data-driven ROI-screened capital allocation. They aren't just spending money because they have it lying around. They're actively prioritizing investments based on quantifiable returns that directly reinforce that B2B growth story. This kind of strategic discipline means only the high ROI projects get the green light, maximizing the yield from every dollar they put into fiscal assets.
Okay, so let's look at their capital allocation stack through that Moneyball lens then. Where did those highly screened dollars actually go this year?
They were very disciplined, very focused. About $33 million went into capex. So that's things like capacity expansion at key plants, necessary equipment upgrades, and pretty crucially these days, defending their operations with investment in IT and cybersecurity. You have to do that. They also paid down $11 million in debt. That left their revolving credit facility completely undrawn, which just, shores up that balance sheet even more. And importantly, they felt confident enough to implement a 16% dividend increase earlier in the fiscal year. That's always a classic sign, isn't it? management believes the cash flow is sustainable.
Definitely. Okay, let's drill down a bit on those B2B engines then, the ones that drove that massive 24% growth. Was this mostly market tailwinds, or was it specific company successes winning share?
It was actually a really nice combination of both. There were three critical areas showing real structural strength. First, fluids purification. That showed strong ongoing demand, particularly in the renewable diesel and edible oil filtration markets. Those are big growth areas.
Right. I remember management specifically calling out the macro driver there, something about tax benefits.
Yes, exactly. They noted that the tax benefits supporting the whole renewable fuel business are directly fueling demand for their products. It drives more soybean crushing and processing capacity, which means, well, direct benefit to their sales. They're essentially kind of a leverage play on the green transition in industrial fuels.
That's a powerful link, a really strong macro connection there. But the most eye-popping number, I think, had to be in agriculture, right?
Oh, absolutely. The agricultural carrier segment was the kind of unexpected breakout star in Q4. It surged an unbelievable 104%. 104% hit a record $11.9 million. And this was driven by a few things coming together. A strong market recovery after the prior fiscal year's downturn, sort of a normalization of purchasing patterns globally, and importantly, they successfully added one new key customer. So this segment showed real structural resilience, bouncing back definitively from those 2024 lows.
Okay. And rounding out that B2B side, animal health or Amlon, that seems to be focused on just consistent growth, especially internationally.
Yeah, Amlon also logged a Q4 record, $8.4 million, is showing solid structural recovery. Their focus really is on continued international expansion. Think high growth regions like Asia and Latin America. They're seeing a return to more consistent, more predictable growth there, especially as global supply chains start to stabilize a bit more.
Okay, right. Now, switching gears a bit, we really have to discuss the retail and wholesale side, specifically cat litter. I mean, this is where most consumers would actually know the company from. We heard competitors really ramped up their promotional activity, heavy price discounts, coupons on traditional clay-based litter. And that apparently tempered this company's clay sales. Now, increased competitive spend, that usually signals trouble, doesn't it? So why does management seem to view this aggressive promotion, especially on lightweight litter, as somehow a net positive for their own strategy? It feels counterintuitive.
It really does feel counterintuitive, but it's actually, I think, quite brilliant strategic positioning. Management absolutely acknowledges the short-term noise in traditional clay. That's real. However, they are prioritizing the lightweight category. Why? Because it continues to outgrow the overall cat litter market consistently. Over both the 13 and 52-week scans, lightweight is winning. So they actually view the heightened competitive spending on lightweight products as, well, a positive thing, because it forces consumer trial. It educates the marketplace on the convenience benefits of these lighter products. And since they have strong branded and private label lightweight stereos, they ultimately benefit from that overall category expansion. They're aiming to secure long-term market share, even if there's some short-term pricing friction. Makes sense.
Yeah, that actually does make sense. It explains their willingness to shift their own strategic ad spend to match that competitor trade spend. They're betting on the whole category growing, not just defending their immediate slice.
Smart. Okay, let's turn quickly to strategic execution, sort of beyond the segments. The Ultra Pet acquisition from back in May 2024, that seems to be going really well, like a textbook example of synergy success.
Yeah, it seems incredibly smooth.
Yeah.
It actually exceeded their distribution ad estimates right out of the gate. It added key talent almost immediately, and crucially, it created those co-loading synergies they had projected. Combining their traditional clay products with the acquired crystal products in the same shipments, saving costs right away. Textbook.
Good to see. And on the innovation front, the new R&D VP has this vision emphasizing aligning innovation with the core mission, just creating maximum value from sorbent minerals. That vertical integration they have literally from the mines to the market, that's got to be their unique, powerful competitive advantage.
Right.
Absolutely. They highlighted that unique control over the entire value chain. They also touched on using artificial intelligence, AI, but with a pretty cautious, phased approach. They use that crawl, walk, run philosophy.
Right. That phrase is everywhere now, isn't it?
Yeah.
But to make it a bit more tangible for you listening, where exactly are they starting to test AI in their actual operations? What does crawl look like?
Well, they're focusing on foundational tasks first. Things where the data is already good. For instance, testing AI to optimize, say, crushing and processing efficiency right at the mine level, using predictive modeling for equipment failure, throughput optimization, areas where data quality is already pretty robust. They really stress that until you have clean, high-quality data, any AI application is basically useless.
Yeah.
You know, the old garbage in, garbage out principle. That's paramount before they even think about rolling it out to more complex areas like R&D itself.
Okay, makes sense. Now, here's where, for me, it gets really interesting. Despite achieving this record year, signaling clear operational leverage, management offered explicit guidance caution for the near term. They warned about tough comps, tough comparisons in the first half of fiscal year 2026. Now, this often causes panic, right? Yet the stock soared. Why did investors seem to completely shrug off that short-term warning?
Yeah, it's fascinating. Investors looked right past that short-term noise because I think they focused squarely on the quality of the earnings and, more importantly, the underlying cash generation. Management was very, very clear. The first half of 2025 was so strong that the year-over-year comparison in the first half of 2026 will inevitably look deceptively difficult. It's just math. However, and this is key, they immediately followed that caution by expressing confidence. Confidence in delivering growth for the full fiscal year 2026 that actually beats fiscal year 2025. Full year growth is the message.
Right. And this confidence seems tied deeply into a more nuanced concept the CEO discussed, something he called capital recapture. Now, this feels like the core insight for anyone really analyzing this company. Can you break down what that means, especially regarding paper margins versus actual cash flow?
This is absolutely crucial. Yeah. Management is basically pricing their products today to reflect the much higher replacement cost for the assets they use down the line. So think of it like replacing an old, aging piece of heavy mining equipment. The new machine might cost 50% more than the old one did years ago, even though it's essentially generating the same base revenue from the ore it processes. Now, because they have to price their products now to cover that future replacement cost, their annual depreciation expense has jumped significantly. It went from about $13.5 million back in fiscal 22 to $22 million last year. So this higher depreciation, it naturally pressures margins on paper. It makes the reported earnings look a bit lower than they might otherwise. But critically, they are generating the actual cash sufficient to fund that eventual replacement when it comes due.
Okay. So the CEO's famous quote really sums up the whole strategy here, doesn't it? Earnings are an opinion, cash is a fact. And the market is clearly buying into the cash fact, which is being funneled into that B2B expansion.
Exactly right. And the proof is in the pudding, or maybe the stock chart. The fact that their one-year total return is up, 83.7%?
Yeah.
That just vastly outperforms the broader consumer staples ETFs, the XLP, which is actually down about 4% over the same period. Investors aren't judging them just on paper margins. They're judging them on disciplined capital allocation and strong cash conversion.
Okay. Now for our regular segment, which, as always, comes with the full legal disclaimer. This is absolutely not financial advice. We're just, trying to spark some creative thinking based on the call analysis we just did.
Right. And this analysis raises an important question, doesn't it? If we accept that the strategic B2B drivers are real and structural, what's the tactical trade setup look like?
So what is the outrageous but plausible trade idea? Based on this sort of confluence of record growth on one hand and this cautious near-term guidance on the other.
Okay, so the thesis here is maybe to go along the equity, but specifically into a potential Q1 or Q2 fiscal 26 pullback. Remember, management explicitly warned about those tough first half comps. This creates a potential setup, right? A setup for a pullback if a short-term headline number happens to miss estimates purely because the comparison base from last year is so high. It's the kind of pullback the market could easily overreact to in the short term.
So you're essentially betting on the market being a bit short-sighted there. But, is there a real risk that maybe those B2B macro drivers like the renewable diesel demand you mentioned could actually soften, making those tough comps a genuine threat, not just an accounting issue?
That's definitely the key risk, no doubt about it. However, the thinking is that the structural B2B drivers, renewable diesel demand, the agricultural recovery, that lightweight litter expansion, these all feel like multi-year trends, not just a flash in the pan. And crucially, remember that $33 million in capex they spent this past year, that's designed specifically to bring new capacity and operational leverage online right now. So the trade idea is essentially buy that potential dip if the tough comparisons do hit the Q1 or Q2 earnings headlines. Or perhaps initiate a long position now, but with a very tight stop loss. It's ultimately a bet that the underlying cash generation, which we know management prioritizes, and that B2B acceleration will lead to a significant reacceleration in Q3 and Q4 of fiscal 26, fundamentally overpowering any short-term comp noise.
Right. A clear bet on operational expansion, eventually winning out over those tricky accounting comparisons. A very bold analysis of the tape there. Okay, so to quickly recap this deep dive, this earnings call really told a powerful story, didn't it? A story of a successful strategic pivot in action. The B2B momentum, combined with that disciplined Moneyball capital allocation, secured a record year. The market rewarded it immediately, even as management prudently guided on those challenging near-term comparisons, all explained by their capital recapture strategy.
Exactly. And looking ahead, given management's stated focus on M&A opportunities, specifically ones closely aligned with sorbent minerals, and considering their fortified balance sheet with over $50 million in cash, this really raises an important question for you, the listener, to think about. Where will that cash dry powder be deployed next to further accelerate this B2B-led growth narrative? What's the next move?
That's certainly the ultimate test of their Moneyball discipline, isn't it? Well, thank you for joining us for this deep dive into the numbers that matter. We'll be back soon with another one.